Hello everyone, this is Dev and welcome back to the channel. So today in our video, we are going to see at the various volatile conditions of the market and how a trader can interpret these scenarios with the help of a real example and understanding India VIX alongside. Okay, so without any delay, let's dive in. Starting with India VIX, it is essentially a fear gauge for the Indian stock markets, reflecting how much the traders anticipate the index to fluctuate over the period of next 30 days. This is the expected volatility of the Nifty 50 index, and it is calculated using the Black-Scholes model, the same which is also used for calculating the implied volatility. Now let us understand the interpretation of VIX. A very high VIX resembles uncertainty, whereas a low VIX resembles stability. Therefore, a rising VIX indicates chances of premium gain, whereas a falling VIX indicates chances of premium decay. We also have the conclusion that India VIX is inversely proportional to Nifty 50. That means whenever India VIX rises, Nifty 50 falls, and whenever Nifty 50 falls, India VIX rises. But for us to understand how the entire game of volatility goes on, we should be looking at the order book. So let us understand how the volatility cycle goes on. The order book is interpreted by the institutions and algos to trigger certain limit orders, which then increases the VIX, that is further interpreted by traders to act upon and increase the IV of OTM contracts by purchasing them to mitigate their risk. Because the uncertainty increased and the traders acted upon the OTM contracts, this further gets reflected into the order books, and that is how the cycle goes on. Let's come back to the main theme of the video, which is to understand the time series of volatility during the period of Operation Sindoor. We already have an assumption in our head that VIX is inversely proportional to the Nifty 50. So starting from the very first day, the Pahalgam attack happened on 22nd of April, which transcended into the market volatility of 24th April because that was an expiry. Since then on, we saw the VIX was on an uptrend and the choppiness drastically increased till 9th May when a ceasefire agreement was declared between two nations. But we didn't see a fall during the previous days because India was a dominant nation among the two conflict nations. Okay, now this 12th of May had a lot of geopolitical confluences favoring it. First of all, the Trump reducing tariff on China, and that being a positive news for India being in Southeastern Asian region. Secondly, the price didn't show sharp fall also because the quarterly results were positive and the outlook for FY 25-26 was brilliant. But since 9th May, we saw a correction of VIX by 5 points. That helps us to conclude that if VIX is rising, we would be following a non-directional strategy, whereas if VIX is smooth and trending, we would be following a directional strategy with adjustments. Now we do have the ultimate motto in our head that theta gain is only experienced by directional selling when you have a hedge. We should be taking the previous day VIX level and multiplying it with the square root of 52 for us in order to have the price volatility that is expected in the index over the next week. So on the 9th of May, I have the VIX level at 22. Multiplying it with the square root of 52, I get 3.05%, which is exactly the pump the market experienced on 12th May Monday. And this too helps us categorize the VIX into three important levels. First one being below 12, which is very good for scalpers intraday mostly. This also implies that the index is fairly priced on a higher time frame and trades can be held on M15 time frame. Finally, the level above 18 resembles that only non-directional selling strategies should be followed. No naked positions are to be added, may it be buying or selling, and booking of M2M gains or losses with daily adjustments are necessary. We do need to be aware of IV manipulation as well, and gamma explosion happens when the projected level is going to be at the money but is presently out the money, and that is when the IV of that contract is very high and it is much likely to experience gamma explosion. Okay, so in our today's video we had a clear understanding of the analogy behind VIX movement, the correlation between Nifty 50 and VIX, the timeline of Operation Sindoor volatility, the VIX categorization, and how volatility adjusted strategies can be deployed in various scenarios. So if you guys like the content, press the likes button, hit the subscribe and share it to your friends. Follow for more such videos and see you in the next one. Thank you.